quick introduction. Gerald is our moderator, venture capitalist attorney with Nation.io. Dr. Dwyer, Jerry Dwyer, is former professor of economics, one of our advisory board members. If Jerry raises his voice a decibel, he's excited. Looking forward to that. Jonathan Dunsmoore, another advisor with South Carolina Emerging Tech, and Michael Hiles with 10XTS, and David Seroy with Sovereign Protocol. So I'll hand it back to you.
Yeah, thanks, Dennis, and good morning, everybody. This is an interesting switching gears here into the regulatory side and a lot of the policy that I think is sort of developing kind of in real time. My name is Gerald Gallagher. I'm GC at a company called Nation. We launched DAOs. So I'm learning a bit from this panel as well as we talk about stables and banking. Would love to just hear from each of the panelists, maybe just a quick introduction, and then I'm always also curious about, on the policy side, sort of that trip down the rabbit hole and what kind of pulled you into this space or what drives your interest as it relates to the topic. So, Jerry, take it away.
Sure, Jerry Dwyer. So I've been a professor of economics a lot, but I've actually also been associated with various Federal Reserve banks over the years in the research department. And so I've done a lot of research on regulation of banks and money, and I started becoming interested in electronic money going back in the 1990s. For me, it's partly, I must admit, I'm interested in freedom. And so I've been interested in private money for a long time. Despite being at Federal Reserve banks, I mean, there's kind of a contradiction there, but not really. And so that's where I'm coming from in terms of all of this.
So I started in the weird world of crypto as it relates to the Howey opinion and all those kind of fun things as it relates to ICOs. And then I think it was probably later in 2017, someone started mentioning stablecoins and how they wanted to do asset-backed stablecoins and the CBDs things and all this weird stuff. And as a corporate securities lawyer, you know, money transmission is really important. Making sure you got the right money and it's going in the right places can cause markets to go cuckoo if it's not done right. And so seeing that and seeing how even my own clients have been jerked around with investors, as Gerald can attest. Oh, the check's in the mail. Oh, okay. Well, what's the FedEx address, or what's the FedEx tracking number? Oh, I forgot to do FedEx. It's just in the regular mail. Oh, okay. Well, we'll sit on our hands and wait for that. And so with this type of technology, we don't necessarily have to sit on and wait for it. We can see instantly that their legal bills are being paid, or that investment is already made. And even with Bitcoin, as slow as the legacy is, within 8 minutes, we can see the transaction, and that's just absolutely incredible. We had a wire that was caught up from France for 17 days last month. 17 days? It's 2022. It was coming from a known bank, going into Bank of America, correct? It doesn't make sense. So we need a better system. I believe that Jerry can attest that our system is a little bit antiquated and we need to solve it. So I'm hoping there's some smart people in this room that can help us figure that out.
So I'm Michael Hiles. I'm CEO and founder of a company called 10XTS. We are a governance, risk, and compliance Oracle solution for regulated digital assets. And I spent an entire career prior to blockchain in regulatory compliance automation and public sector court case record systems. And that's what blockchain effectively is a single source of truth of common data. From a regulatory standpoint, I'm knee-deep in lots of regulatory from client projects. We incubated the team and spun out as an independent institution a couple of years ago, Commercium Bank, which is the 4th special purpose depository institution, bank charter license in Wyoming. So out of 260 applicants, 4 were awarded. Of course, we'll hear from Caitlin, I think, here in a little while. She's Avanti, Custodia Bank. And then in 23, this year coming, we've been preparing to launch Integer Bank as a Puerto Rico IFE charter as well. So we know compliance so well, they'll even give us a banking charter. frightening.
My name is David Seroy. I'm mostly just a Twitter lurker and Bitcoin researcher. I am not coming at this from the policy angle. I'm probably more representing what I think is more compatible with the Bitcoin ethos. I've seen decentralized stablecoins, something akin of like the free banking area of what Selgin and White talk about, with over-collateralized stablecoins and kind of a more free banking model.
Great. So let's start with I guess the skepticism or the cynicism as it pertains to stablecoins, and we can get into the sort of the different models. One of the, maybe Jerry, you could hit on this. You just kind of mentioned the experience with the reserve banking system. One of the things that you'll sort of see out there is that something like 92% of dollars in circulation are technically digital, right? They only exist ledger to ledger in banks, right? So what do you say when you look at like a stable coin or some kind of a reform to the banking system when that's kind of an underlying assumption? Like, what's the difference between the traditional banking? Jonathan just gave us a great example of the inefficiencies of the wire system, but what do you think about the difference between sort of a ledger dollar in a bank and a stable coin?
From a lot of points of view, there really isn't a difference. And this is a big issue, actually, in terms of regulation and everything else. I'll be upfront. So me personally, I think the best way that stablecoins could operate is not as standard chartered banks under current charters, but with special charters that let them operate with 100% reserves. Now, why do I say this? It's because having done a lot of research on banking history, actually, it's important to realize that banks in the US have never been corporations. Never. They've always been regulated differently. And the major part of that regulation is actually related to examination. That is, you take like Tether, well, what assets do they really have? All right? If they had a bank charter, then you're going to end up with examiners going in there and they're going to publish what their balance sheet is. And so like in the 1840s, in the free banking period, you can go today to your some libraries, and you can read the assets that were held by all of the banks. And that's because the examiners went in and discovered that. Now, why is that important? That's important because it prevents issues that arose recently with one stable coin of runs. That is, that people become worried whether they're going to be able to redeem. And if they have 100% reserves, which is what I'm suggesting, then if people come in and want to take it all out, it's there. Unlike with this, and I don't mean to knock regular commercial banks, but unlike with a regular commercial bank where, well, they have fractional reserves. And they make loans with the assets and they pay you interest on your deposits and other things, as opposed to being a custodian for your assets. So that's probably a long-winded answer to your question.
No, that's perfect context for a question I have for Michael, which is, so you've gone through the process of getting a bank charter, right? And we've seen sort of on the fintech,
All 1,100 pages of application.
right? So that's a lot of paperwork. What are, I guess, some of the hindrances? Like Jerry just highlighted, sort of the reserve system, and we can get into that. But what are some of the challenges that you see with? I guess one is just going through the process. And two is maybe just even educating regulators on what you're doing, like what you're trying to achieve.
That's a big part of it, and Wyoming brings a special set of circumstances. They were kind of the first to run down the road, and they did it in sort of out of sync with the American Bankers Association, and who has since Bank Policy Institute took a very dim view of the Wyoming SPDIs. And so it's not resolved. It's not going to resolve until it sees a federal courtroom, which of course Caitlin led the charge with the 4 Wyoming charters to be the first to sue Kansas City Fed. One of the problems, just simply from a bank charter standpoint, is the minimum reserve ratios that are necessary to even capitalize a charter. Now, granted, there's a significant amount of risk that's baked into it and compliance. But then one of the other interesting aspects is the fact that in particular Wyoming, because as Jerry referred to, the narrow bank, it's a 100% reserve operating services institution. The federal government, the Treasury Department, doesn't see it as being a legitimate bank because it's not subject to FDIC purview, right? So now, well, we're not going to give you Federal Reserve window access as a bank charter because you're not really a bank, which has been a very interesting dichotomy and contrary to the idea of 100% reserve banking. And if you'll recall, in 2020, we had a little incident with a international healthcare crisis, and banking reserve ratio requirements went to 0. So banks no longer even have to have cash or asset reserves on the balance sheet to represent their lending, which is a house of cards, if you ask me.
So yeah, I want to bounce off that because I have two people that are smarter than me next to me. And so one of the things that, in my mind, whether it's full 100% custody reserves or just even maintaining balances and reporting it to whatever regulator is supposed to give you insurance or say that this is justified and good and gracious. If I were to create, let's say, a private stablecoin, even if it's 100% backed, let's say a full 100, how would I earn off of that? Because what it boils down to, even for traditional banking, even for 100% reserve banking, we're still loaning the money out. We're still giving it to someone to earn a yield, or else we're not making money. And so, in your eyes, how do we solve that? I want debt on a blockchain. I want to be able to know who's got a little bit of a gambling problem, or whether they're corporate gambling or, at the roulette table.
Well, I don't see debt as bad. I see money based on debt as bad. Right?
Failing to report it, right? Because that's how we got
right.
to the 3 arrows issue.
Yeah, the house of cards that we have with monetary policy today in the United States is very clearly we have basically debt-based currency. So the only way that we can continue to ensure the value of our currency is to expand the debt. Well, that's not the only side. Where's the equity side of the balance sheet in some of these policy discussions?
I'd like to maybe just represent the other side. So I am definitely a fan of over-collateralized, narrow banks, full reserve. But at the same time, it's a little bit of a pipe dream. It's unrealistic. And the Federal Reserve won't admit this, but if we had a narrow bank, it essentially pulls liquidity out of the system. People are spending less. The economy potentially spirals into a depression. So if we started from a blank slate, I would love that we were narrow banks and fully reserved, but right now it's probably not realistic. If we take centralized stablecoins like Tether and USDC, and they're taking those dollars and they're investing them in short-term treasuries, that pulls out collateral from things like the repo market, which is really the engine of dollars in the world. So these typical stablecoin solutions, like, we're just dreaming a little bit. And this idea, like, even if we regulated and said, hey, every bank has to be 100% reserved, like, it's already been proven for 50 plus years, this shadow banking system and the Eurodollar system, which is almost 10 times the size of the Federal Reserve, like, they're going to create dollar liabilities at whatever reserve ratios that they want. So while I love the sentiment, it's probably unrealistic. A superior solution is building these stable coins in these credit instantiations on chain, and where if you put Bitcoin into a smart contract and you mint credit or dollars or stable coins against that, not only are you seeing the outstanding liabilities on chain, so it's not like it's the shadow banking system where there's this kind of you have no idea how many actually dollars exist. You can see it on chain how many dollars actually exist, and you can also see on the equity side of the balance sheet how much collateral is actually backing that, and that's what's going to allow the free market to go in and check some of these systems. Say you're fully reserved, great. You're under collateralized. Well, we're going to attack it like Soros did for the British pound. So,
but you don't want that. You can't have in a stable system Bitcoin falling to from 40,000 down to 18,000, and then all of a sudden
Totally agree. But I actually agree with
collapse
you.
of the financial markets.
But you can't. Well,
This is great. So Jerry, I want you to say what you're going to say, and then I think we have to get into the two things that I think we're sort of circling around are scale and volatility. Right, I think those are both incredibly important elements of a currency, and I want to get into that. But Jerry, I think you had something to add.
Okay, I think I turned it on. Yep. Okay, there's one question, which is, what are the reserves? All right. Now, the first thing to realize is okay, these digital banks, stable coins, they don't promise to pay Bitcoin. what they promise to pay is dollars or euros or other things, okay? So their assets have to be denominated in that. Now, for the Federal Reserve and for the ECB, as a matter of fact, how can you earn funds if you're a bank? Deposit it at the bank, at the central bank. They pay interest. They pay interest more than short-term treasury bills, as a matter of fact, a source of some concern. And so that's a great investment as long as you can do it, all right? That's why there's a big issue about, it hasn't really come up directly, but master accounts at the Federal Reserve. That's why they're suing the Kansas City Fed, is because rather than holding their deposits at Bank of America, they want to hold a deposit at the Fed, and the Fed pays a lot more. So that's how you can hold the reserves, and you're good. You have a very nice, profitable stream of low-risk income.
But you have to have the master account.
Yes. No. And it's important that these banks be able to get master accounts. I mean, realistically, that's a matter of it's going to require federal legislation.
So
That's the only thing that's going to force the Fed to do it because they don't want to do it.
So I can give you a quick insight on our thesis for Commercium Bank, because I actually agree, right? In my world, Bitcoin's awesome, but from a banking and a reserve standpoint, Bitcoin is no different than the US dollar. It's based on the economics of belief of markets, right? Somebody says it's worth something, somebody else agrees, cool. That's an open marketplace. Our thesis at Commercium was the monetization of everything, real world assets. How do we transform real estate into a form of interoperable digital forms of currency, right? And in that instance, you're binding the equity side of the equation. You still have to have a custodian that represents to the regulator that this asset exists, it's audible, et cetera. But you've eliminated sort of the same question mark about volatility. I mean, I call the U.S. dollar everybody says U.S. dollar is less volatile than Bitcoin. I'm like, really? What was inflation last month? That doesn't seem less volatile to me. But the point is that there's other thought processes around how do we actually normalize the equity side of the equation.
Yeah, so I'm very curious about digging into sort of the $60 billion train wreck that happened over the summer that we've kind of alluded to, right? And so I'm going to try to explain what happened, and then I just sort of discuss, right? Because I think we have the right brains here. Basically, Terra was an algorithmic stablecoin, right? That was supposed to be pegged to $1 through a mix of assets, right? So it had sort of a sister token, Luna, that was essentially meant to go up in value, offsetting sort of, and then Bitcoin, where sort of these two assets combined with the price of Terra were supposed to have Terra pegged at $1, right? And that is a terrible explanation if you are following this closely. But that's essentially what happened. Basically, there was an attack, right? And this is debated in the community, but that depegged Terra from the dollar.
It was
right?
an attack.
Right. And so, yeah. And so the founder is now currently on the run, not on the run, right? It's depending on what his Twitter says today. That was I think a major issue for the adoption of algorithmic stablecoins, and I'm very curious about what you have to say on this. But how do you avoid that? How do you prevent that without instantly having sort of the $1 trillion that you need to provide stability?
Yeah.
Something like that.
So no, I definitely like to take this one. I mean, Terra Luna, it was never a stable coin. Like it was a mockery to even call it a stable coin. Like even in their white paper, they described the kind of death spiral scenario that happened. Like anybody that was doing research and that was like clued into it, like clearly knew that it was completely unstable. And so it's really put a stain on the rest of the stablecoin industry and people that have built legitimate, over-collateralized, 100% reserve products that have maintained their peg that provably are much more legitimate. And so I just, I challenge like everybody on the panel here and in the audience to understand that there are other better instantiations of stablecoins. Like what MakerDAO pioneered years ago is a great model, but even that one was flawed. Nowadays, we're seeing something like Liquidity or what Sovereign has built, Zero, which is provably, again, any liabilities in stablecoins that you create, you can prove that it is over-collateralized and backed. Like, this is the vision that we should go towards for this narrow bank idea. Like this traditional legacy world of, hey, let's get the Fed to regulate and pay out interest. It's just unviable. Like, we need to build it on-chain, and if anybody wants to talk to me afterwards, like, I can explain how this is fundamentally different from something like Terra Luna. Like, it shouldn't even be discussed. It was never a stable coin.
So does anybody watch Rick and Morty? Quick raise your hands, right? When Rick changes the universal dollar to zero and everything like blows up, that's kind of where we're at, right? Because if we over-collateralize everything and we have all of these reserves that have to be backed by something else, it just creates ultimate chaos because we have to overstack something to create one of something that's stable. To me, that's effing stupid. That's really, really dumb. We need to have smarter people come up with a better solution. And whether that is, full reserve something, I'm probably 100% on board with that. But as I've argued with regulators, as I've argued with senators, we have to come up with a solution because the current system's broken. So let us play around. Let us get some banking charters. Let us try some, stable coins that maybe possibly even be approved by the Fed in a sandbox or two, God forbid, and see what we can break. I'm very hopeful that Curtis Lofton will allow us in South Carolina to play with some of these assets when we have a cataclysmic event like a hurricane, God forbid, and we can tell people, through their smartwatches or through their home addresses or through their licensing information that, oh shit, this person just had their house wiped out. Maybe they need $1,000 or $2,000, right?
Yeah, I think this is a discussion that will hopefully continue at happy hour. If anyone is interested, I think we could do this for another 2 hours. Unfortunately, we're out of time. I want to make sure if we have like maybe 1 or 2 questions, go for it. Yeah.
Well, I can
Yeah.
so my question, I have a question. There's a Forbes article that says like half of all Bitcoin transactions are basically wash sales. So in order to kind of try to prop up the price of Bitcoin, what regulation should be instituted in order to avoid that? Because wash sales are technically illegal, but because it's Bitcoin, it's hard to follow those people. So what do you say about those kind of wash sales? And then the other question I had, I can't remember right now. But that's the biggest one.
I think that's probably something that we're going to cover on our panel this afternoon on digital assets and regulation. But if you guys anybody want to take a stab at that?
No math will solve for bad human behavior.
Yep,
Amen.
That was my other question, was basically dark markets, using Bitcoin for arms sales and all that kind of stuff.
So this is like the first time we have something that's just super powerful that's never been done before, right? That can be traded 24 hours a day, 365, all over the world on your smartphone. And so we have to be able to figure some of that out. Does that mean full banking grade KYC? God, I hope not. But does that mean we are trying to track down the bad actors and see who are doing, the on and off ramps of fiat from Bitcoin and with these, illicit transactions? Absolutely. So it's kind of in that like weird gray area where, Bitcoin, we see the value, we see the transactionality need, but at this point, there's still going to be bad actors, and we're all a bunch of monkeys in clothes, and we can't solve for everything.
Well, I mean, it's just, for me, it's trying to figure out where is that balance?
Yeah, we're going to get the Apollo here. So I want to thank you to the panelists. Fantastic discussion again. I hope it continues around the bar this evening. And thank you, Dennis, for putting us on.
Thank you.